Hello everyone, this is Bhavik Chokshi over here and welcome to the revision video for Ind AS 21 which is on foreign exchange. So this video will be helpful for students who are in their first leg of preparation for a very quick revision of all the concepts which are there in Ind AS 21, as well as if you are preparing before and revising just before your exams. This should be very helpful. We would not be discussing, we would not be solving sums over here, but we would be giving you the entire background concepts and explanations which involve Ind AS 21. As you would be aware, this is a standard on foreign exchange and one of the important standards in your CA final FR syllabus. Now, this is one standard which the institute mixes and matches with other standards as well, like for example financial instruments, for example leases, and hence it assumes slightly more significance as well, because this is something which can be asked with other standards quite easily. So let's dive into this. Now, the standard on foreign currency revolves around this concept of functional currency. When we studied AS 11 in our inter-CA, we had this concept of home currency and foreign currency, where we were saying that, well, you know what, if you are a company based in India, you have to maintain your accounts in the Indian rupee. That goes naturally as per AS 11. However, Ind AS says that why should that be? Why should you be so patriotic merely because you're registered in India? Patriotism is good, but we are trying to do accounting over here. So in terms of accounting, ideally the accounting should be based on the primary economic environment in which you operate. So for example, like a coaching institute like ours, we operate in India. We kind of sell our courses to students in India. We receive Indian rupees. We kind of incur our expenses. Our vendors largely are in India, and our competitors are also in India, and as a result the primary economic environment in which we as a coaching institute operate is an Indian environment, and hence our accounts should be in the rupees. However, if there is a company which is probably registered in India, like a company who is, let us say, in the business of let's say buying and selling let's say Indian made food in overseas countries only, let's say someone like a Patel Brothers, for example, a hypothetical example, where you have it's one of a big store chain in the United Kingdom, US, etc. I'm just giving you a side reference, don't go into too much technicalities. So let us say this is a company which is based in India. Hypothetically, it is a company which is registered in India. However, it is not selling these Indianized foods like papads, theplas, pickles, etc. in India. It kind of has employed employees in the US, in the UK, etc. They kind of make these Indian foods in the US, in the UK, and sell it in the stores as well as online to UK customers, to US customers, to Canadian customers. In which case, one can say, let us say, one can say that what should be the currency in which Patel Brothers should maintain their accounts? One would say, well, as per AS 11, it's a company registered in India, and hence you should prepare the accounts in rupees, which technically means that every purchase transaction, every sale transaction which is in dollars will have to be converted into rupees. Now this poses a lot of challenge, because in reality the company, except for having a few administrative staff in India, largely has its operations in the US, but for whatever reasons it is registered in India. So the standard over here kind of goes beyond that, and it says that forget the country of your registration, look at the primary economic environment in which you are operating. You are incurring your expenses in the US, you are earning revenue in the US, your competitors and the economic environment in which you operate is a US environment. You have to meet the food and safety guidelines of the US regulators. Well, then ideally in your tally, in your SAP, in your accounting software, the entries that you should be passing should be in the US dollars. So we are registered in India, let that be. The word home currency does not appear across Ind AS 21. It does not really matter in which country you are domiciled. It matters which is the primary economic environment in which you operate. As you would be aware by now, this is subjected to a lot of degree of subjectivity and can change depending on the facts of the case, depending on what the management views is the primary economic environment. And hence, questions directly on identifying functional currency are relatively rare, though the concept of functional currency is quite wonderful. So what is the functional currency? Functional currency, for example, for Patel Brothers, should be the US dollars, because it is the primary economic environment in which they operate. For example, if US was the only environment, let us say. irrespective of where they are registered. But for a coaching class like ours, it will be rupees, not because we are registered in India, but because our primary economic environment in India. So all our entries will be in rupees, and if we enter into a transaction in other than rupees, then that will require conversion. Fair enough. Patel brothers, all the transactions will be in dollars. However, if a transaction happens in rupees, we will have to convert it into dollars. And that is the beauty of functional currency. It is the currency of the primary economic environment in which we operate. The significance of this currency is the transactions will be recorded in the functional currency. So this is what is mentioned about the functional currency. I'm not doing a page-to-page read. You can refer that as well. Now, what is foreign currency? Well, foreign currency is defined as a currency which is other than the functional currency, not other than the home currency. It is a currency other than the functional currency. So for example, for Patel brothers, the dollar is the functional currency. So every currency other than the dollar will be the foreign currency, which means even the Indian rupee will be the foreign currency. For us, the Indian rupee is the functional currency, which means every currency other than the Indian rupee will be treated as a foreign currency. So what is the significance of this? Well, all the transactions that happen in the foreign currency need to be translated into the functional currency based on the rates as prescribed as per Ind AS 21. So that is the foreign currency. And last is the presentation currency. What do you mean by presentation currency? Typically, the presentation currency will be the same as the functional currency, but that is not mandatory. It is very much possible that I am an Indian company, I am presenting my accounts in rupees, and I should prepare my financial statements also in rupees. A company like Coca-Cola India Private Limited, let us say, is a wholly owned subsidiary of Coca-Cola US. Now, Coca-Cola India Private Limited sells goods to the Indian customers. Sales are in rupees. Incurs expenses of production and manufacturing in the rupees. Expenses are in rupees. The competitors are the Indian soft drink manufacturers, and hence the economic environment is largely the rupee environment. However, the entire purpose, so it will record the transactions in rupees. Their tally, their SAP would be in rupees. However, the idea of preparing financial statements, that is the balance sheet and the profit and loss, is to smoothly facilitate a US consolidation. And as a result, one can say that, well, let the entire tally be in rupees. But when we are presenting our balance sheet and the profit and loss, let us present it in the dollars. Is that possible? The standard says yes. If nothing is given, the functional currency is the presentation currency. That is a currency in which you present the financial statements. However, that is not mandatory. The functional currency may be a currency which is different, and presentation currency may be different. How do you convert them? Well, the standard will guide you for that. So presentation currency is a currency in which financial statements are presented. After that, we have the determination of the functional currency. The functional currency over here, the determination rests on the primary factors. So ideally, you should only look at the primary factors for making the decision, like which is the currency which influences the sale of the products, which is the currency which determines at what price the product should be priced for their sales. Secondly, the currency which influences the costs or the expenses, like for us the faculty cost, the rent cost, etc., which is the currency which mainly influences our expenses. And lastly, the currency which affects the competitive or the regulatory environment. In the two examples that we discussed of our coaching institute as well as Patel brothers, over here everything was consistent. So sales pricing for us as a coaching institute is rupees, expenses rupees, the competitive environment being the Indian environment, and hence we don't even need to look at any other additional factors. Same is the case with Patel brothers, the sales pricing in dollars, all the expenses largely in dollars, and the competitive environment being the US environment. So the functional currency is the dollars. However, there can be certain businesses where you can see that the competitive environment, or let us say the pricing expenses, may not be as clear. For example, if there is a BPO, business process outsourcing unit, which is based in India, and hence all its employees, all its costs, etc., are incurred in the Indian environment. So for the BPO, the costs are in rupees. However, it is largely catering only to the US operation of certain mobile companies like AT&T, in which case we are kind of stuck that should the currency be the dollar or the rupee. Yes, let us say the competitive environment is also quite mixed. The labor laws, etc., of India have to be followed, but the customer service requirements of the US has to be followed. So we are kind of in the middle of nowhere. In which case, how will the management determine the functional currency in such cases? You should go to the additional factors. Sir, what are the additional factors? Well, sources of finance. From where has the BPO largely raised its funds? Has it done its IPO and its loans, etc. in the US? In which case, the functional currency should be the dollar. Additional factor. Has it done in India? Then the functional currency should be rupees, and the currency in which the earnings are usually retained. So after meeting all the expenses, the profits that we have, we typically save them, we retain them, we invest them. Where are you investing them? Are you investing them in the rupee, in the dollar? And that will give you an additional insight into what should be the functional currency. So sir, do we need to look at all the 5 things? The sales pricing, expenses, competitive environment, sources of finance, retention? No. You should only look at the primary factors, and if the primary factors are unable to give you a conclusive decision, only then should you go to the additional factors, and then based your judgment on some additional factors. So as you would see by now, there is a fairly high degree of ambiguity, not really ambiguity but subjectivity, which is fact based, and hence the institute has incorporated a few case based illustrations in the study material which you can refer. However, in the exams, they have not really come up as often because of the high degree of subjectivity. Having said that, we have discussed how to identify the functional currency. Okay, now we go to the second part of the standard, that what if there's an entity, there's an Indian entity, for example, which has no subsidiaries, no associate joint ventures, a simple Indian company whose functional currency is the rupee. It enters into a transaction to sell goods to a US party, which is going to pay you money. So that's a foreign currency transaction because the invoice is denominated in dollars, or an Indian company which decides to import equipment from the US, which is again a foreign currency transaction. So the question arises, at what rate should you convert these foreign currency transactions? Now, before we go into understanding the conversion rates, we need to understand 2 important concepts. First, what do you mean by a monetary item? What do you mean by a non-monetary item? Monetary item refers to those items whose amounts are fixed contractually. The amount that you are going to receive is contractually determined. It is contractually fixed. You know what you are going to get or what you have to pay. On the other hand, a non-monetary item is generally an item where the amount that you're going to receive or pay is not contractually determined or fixed. Sir, nahi samajh mein aa raha, we can't understand. For example, if the debtors are agreed, a credit sale is 33,333, you are going to get that contractually, not a penny more, not a penny less. And as a result, that is a monetary item. If there's a loan of 10 lakhs, I have to pay 10 lakhs. Along with interest, and hence it is a monetary item. The amount that I have to pay or receive is contractually fixed. Items like debtors, creditors, bank balances, loans are all monetary. On the other hand, if there's a plot of land which is $100, well, I go to sell it. I mean, I don't have a contractually fixed or determinable amount of value. I might get 1,000, I might get $10. We don't know. And as a result, tangible items like PPE, intangible items, equity investments, all of these go into the non-monetary category because the amount that you're going to get is not contractually fixed or determined. The amount in the balance sheet does not reflect the amount that you are going to probably contractually receive. And hence these are non-monetary. Fair, you might have studied about monetary and non-monetary even in your AS11 inter-CA. Okay. So what is the rate at which you should convert these foreign currency items? Well, if I were to enter into a transaction on 1st of January, whereby I am actually doing a credit sale of $100 on 1st of January, when the exchange rate is, let us say, rupees 50 per dollar. In such a case, you will pass the entry debtor account debit to sales. However, the invoice is in dollars. You need to convert it. At what rate are you going to convert it? You are going to convert it at the exchange rate prevailing on the date of the transaction. So your journal entry will be debtor account debit to sales. I'm not passing the entry at 5,000 rupees. Okay. Let us say this is on 1st of January and the credit period is 5 months, which means as on 31st March, which is the balance sheet date, the debtors are still not settled. And hence, what do you do now? Well, the balance sheet items have to be classified between monetary and non-monetary. Remember, balance sheet is as on date. Income statement is not as on date. Income statement is for the period, which means the sales which are recorded at 5,000 rupees are not as on 31st March 11. It is for the period of 1st of April to 31st March 11, for example, which means you don't have to remeasure the sales. You don't have to remeasure the sales, remember, but you have to remeasure the debtors. Sir, why? Because balance sheet is as on date. So when you are kind of in very loose and layman terms, when you're preparing the balance sheet, it is like you're taking a selfie of the company, you're taking a picture, you're taking a snapshot. Whereas the P&L is a flow concept, it's like a video for the entire year. So we are saying that, okay, throughout the year, we earned a sales of 5,000. That was earned on 1st of January 11. Acha, is that within the year 10-11? Yes. Well, you don't need to remeasure the sale item that goes in the P&L. So in your P&L, sales will continue to appear at 5,000. However, in the balance sheet, you cannot say that debtors as on 31st March 11 are going to be worth $100 into rupees 50, and as a result we will have to look at the exchange rate. Let us say hypothetically the rate becomes 60 per dollar, which means you have to now first determine whether the debtors are monetary in nature or non-monetary. If they are monetary in nature, the standard says you have to convert them at the closing rate. Sir, why? Because the amount is fixed, the amount is determinable. You are going to get $100 only, and the $100 that you are going to get can be converted at the rate prevailing as on the date of the balance sheet, which is rupees 60 per dollar. So over here, monetary items are converted at the closing rate. Perfect. This is something that you have studied even in your Inter-CA AS11. Then comes the non-monetary items, something like land, for example. Let us say you have purchased land on a cash basis, land account debit to bank, you have paid the money, 5,000 rupees. Comes the balance sheet date, you are following the cost model. Now the rate becomes 60 per dollar. One can argue and say that, okay, the land should also be remeasured. It's a non-monetary item, should also be remeasured at the closing rate. Why should that be? Well, because if I go to sell the land, I'll get $100. That is where you go wrong. When you go to sell the land, you are not necessarily going to get $100. It's a non-monetary item. The amount appearing in the balance sheet by no means reflects the amount that you're going to get contractually. And as a result, well, if I'm not even sure whether I'm going to get 100 or not, then what is the point of even calculating a foreign exchange gain or loss? It's not really required for you to understand this logic, but just on why non-monetary items are to be kept at cost, the logic over here is non-monetary items, the underlying value itself is not fixed or determinable. So if that $100 is not sure, then the gain or loss on 100 is also an uncertain gain. Then why should you recognize a gain or loss on 100 when you're not even sure that 100 is going to be recovered? And hence, as per AS11, Ind AS 21, non-monetary items continue to remain at historic rate. Now, AS11, most of the times, non-monetary items would be at the cost. However, under Ind AS, there are a lot of items which require a fair value measurement. So, for example, there can be investment in equity shares which are measured using FVTPL, FVTOCI, for example, or there can be a property, plant and equipment which can be measured using a revaluation model, in which case that $100 will change. So for example, the land was $100, let us say, and at the balance sheet date you were following the revaluation model and you remeasured the land to $150. Now this $150 is a value on 31st March. So ideally the exchange rate should also be the rate on 31st March. Sir. But is the revaluation to be done every year? No, it has to be done at sufficient intervals. You revaluated at 150, next year you did not do a revaluation, the year after you did not do a revaluation, the year after you did not do the revaluation. You will continue to show it at the rate on the date when the fair value was determined. So long story short, if it is a non-monetary item which is to be shown at fair value, then the exchange rate to be taken should be the rate on the date when the fair value was determined, because the value in the balance sheet is not the value as on the date of purchase. The value on the balance sheet date is the value on the date the fair value is determined, and hence the exchange rate should also be the rate as on the date when the fair value is determined. Okay, so we'll just summarize this. This is an important chart. The conversion principles, this is for foreign currency transactions which is done by the entity. For initial recognition will be at the spot rate on the date of transaction, that is the date of sale. You will not change the income statement item. Subsequent recognition for the balance sheet date, well, for the non-monetary items, this is important, non-monetary items which are at historical cost. Classic example, PP using the cost model. Historical cost, you will take the historical rate only, that is the rate as on the date of the transaction. However, if these non-monetary items are to be at fair value, investment in equity shares, which are at FVTPL/FVOCI PP using revaluation model, then you will take the rate on the date when the fair value is determined. An apple to apple comparison. Monetary items have to be at the closing rate. Always. Logic, the amount is determinable, so you should be in a position to calculate gain or loss. Accounts has this principle that if you cannot determine something reliably, don't determine it at all. So something like self-generated goodwill is never recorded in the books because you can't reliably determine it. In a similar way, for non-monetary items, a gain or loss cannot be reliably determined if they are kept at historical cost, because the value in the balance sheet does not show the value that you are going to get. Then the exchange rate should also be the rate as on the historical date. If you take 31st March exchange rate, you are calculating the gain or loss based on $100, whereas on 31st March, you are not even sure whether contractually you are going to get $100. So you avoid that calculation. This is the logic. Okay, so this is conversion principles. Achha, iske aage you have to look at the impact of the foreign currency gain or loss. Let us say, for the debtors, we said $100 ke debtor se 10 rupees ka gain hai, so $100 into rupees 10 comes to 1000 rupees. Where should this 1000 go? Debtor account debit, fair enough. Credit kisko jayega? Well, this difference of 1000 is arising because of changes in exchange rates. And as a result, the law says that this should typically be taken into the profit and loss account. So the general principle or the rule of thumb is, whenever there is a foreign exchange gain or loss on a foreign currency transaction, it should go to the profit and loss account under the heading of foreign exchange gain / foreign exchange loss. Profit and loss, straight. However, a challenge might arise for certain items where the underlying gain or loss on the asset is not going to the profit and loss account. Sir, we are not able to understand. For example, land using the revaluation model. So when the land is at $100 and it goes up to $150 under the revaluation model, the upward revaluation does not go to the profit and loss. Instead, the upward revaluation for that non-monetary item goes to the revaluation surplus, which is a part of OCI. So the standard says that, well, for non-monetary items where there is a change in the value of the asset, we don't take the change in the value of the asset, for example, to the P&L, and hence in such a case, if there's a foreign exchange gain or loss on that item, that should also go to the OCI. And as a result, for non-monetary items, this rule does not apply to monetary items. Monetary items will always, the gain or loss will go to the P&L. So whether it is debtor, whether it is creditor, whether it is an investment in bond, which is a monetary item, whatever the item, the gain or loss on a monetary item will always go to the P&L. There is no exception over here. So if you go to see forex gain or loss for monetary items will always be the P&L, period, no exception. However, if it is a non-monetary item, we see where the gain or loss on the non-monetary item is going. If it is going in the OCI, then the foreign exchange, like revaluation is going into the OCI, then the foreign exchange gain or loss will also go to the OCI. If it is going to the P&L, then the foreign exchange gain or loss will also go to the P&L, for example. So this is a general rule. However, there is one exception which is given under Ind AS 21 for this, which is investment in equity shares, which are basically non-monetary, where you have taken the FVOCI item. If these are investment in equity shares where you have taken the FVOCI choice, then the gain or loss on the underlying item, that is equity shares, is going to go into the OCI. And hence, ideally, the foreign exchange gain or loss on such items, so for example, if you invested in shares in Google, should also go to the OCI. However, the standard gives you an exception for items like investments in equity shares, and even hypothetically if there are certain bonds which are under non-monetary items, the standard gives you that exception. Bonds are typically monetary, but standard gives you that exception that for these items the gain or loss on account of the foreign exchange has to go to the P&L. So that is that small exception that you have to remember. So for non-monetary items, typically if the underlying gain or loss for investment in equity instruments which are at FVOCI, then this will go to the P&L. Ideally, in general cases, the forex gain should have gone to the OCI, and in all other cases like PP using the revaluation model, it should go to the OCI. In all the other cases other than the gain or loss, so over here underlying gain or loss in OCI, this is, I think, in OCI, we need to complete this. Underlying gain or loss in OCI for investment in equity shares, the foreign exchange gain or loss will still go in the P&L. In all other cases, the foreign exchange gain or loss will also go into the OCI. For all other cases where the gain or loss is not going into OCI, the underlying gain or loss on the asset or liability is not going into the OCI, well, the gain or loss on the item will go to the profit and loss account. Okay. Now there is one special case which requires mention over here, where you might need to compare and then determine whether there's a write-off or not. So for example, there is an inventory which is a non-monetary item, or there is a PPE which is also a non-monetary item like FETPL, FEOCI. There is no comparison. You have to show it at fair value. However, for inventory, you show it at cost or NRV, or for PPE, you show it at cost or recoverable value under impairment standard, whichever is lower. Now the challenge over here will be, let us say the cost is $100, but the NRV is $90. So one can say that there is a write-off. However, the cost was on 1st of January, whereas the NRV was on 31st March, which means what should you do? Should you compare 190 and say there is a write-off? The standard says no. You will have to convert this at the historic or the rate as on the date of transaction. So cost is on 1st of January, and hence the rate should also be the rate on 1st of January. In a similar way, if the NRV or the recoverable value is on 31st March, let us say you will take the rate also as on 31st March. So in rupees, in the functional currency, the cost is rupees 5,000 for the inventory or the PP, and the recoverable value or the NRV is, let us say, 5,400, and as a result there will be no write-off / no impairment. Sir, but dollar mate is impaired, but you are preparing your accounts in rupees, and in rupees the asset is capable of giving you more than the cost. Whether that is due to an increase in selling price or whether that is due to an improvement in exchange rate, we don't really care. We cannot say that the inventory or the PP is impaired because it is giving you more than the cost in the functional currency. This is what the standard mentions. Another important case over here would be the application of financial instruments and Ind AS 21 together. Especially these are loans taken or given under the amortized cost method. So under the amortized cost method, what do? You take the opening balance of the loan and you recognize the effective interest, EIR, using the effective interest rate, the EIR, which may be different than the coupon rate. So your real income is based on the effective rate. So the loan item is a monetary item, the bond is a monetary item, and hence these monetary items will be recorded based on the closing rate. Okay? Or at the beginning they will be at the rate as on the date of transaction, and at each balance sheet date it will be at the closing rate. Now the problem is, when you calculate this, the effective interest is a concept which is going to be earned over time, over the entire year. It is not unique to a particular date, and as a result effective rate or effective interest should ideally be converted at the average rate. However, coupon or principal repayment happens as on a particular date. Coupon is now no longer interest income, it is just recovery of money. कि भाई $100 का लोन है, उसके ऊपर $10 is the effective interest rate, and coupon, whatever that is, we are getting back. Principal repayment, whatever that is, we are getting back. So over here, this is no longer an interest income. So coupon happens as on a particular date. The repayment of principal happens as on a particular date. Okay. So over here, how will you calculate the gain or loss? Because the closing amount is a monetary item and it has to be at the closing rate. This even applies in leases for lease liability. Institute in a recent RTP even asked that. So the general principle, and we've written a note over there, and there are multiple RTP as well as sums in our book where you can refer, where you will say that the opening balance, Institute may follow whatever method, our answer will be the same. What should you do? You should prepare an amortization cost table in the foreign currency, and then each item you will convert at the respective rate. So when you look at the typical amortization table, you will start with years and then the opening balance. The opening balance in dollars has to be converted at the opening rate. Achha, why should this opening balance change? Typically because of effective interest. I'm writing it in short. Effective interest is in dollars. However, this is earned throughout the year. So if I have to convert this into rupees, I will convert it at the average rate. Achha, but the coupon as well as principal repayment that happens as on a particular date. So this is typically the date when the coupon is paid, and this is the amount at which it is going to get in rupees. Now this will give you the closing rate or the closing amount of the loan. Because it is a monetary item, this closing value will also be converted into rupees at the closing rate. Okay. So, sir, how are we going to find exchange rate gain or loss? the point is exchange rate gain or loss over here is not as easily determined because it is due to a multiplicity of factors. Because interest is at average, coupon is at the date of payment, opening rate alag hai, closing rate is different, and hence ideally if the opening plus effective interest less coupon equals to the closing in dollars, it should also equal in rupees, but it will not because different rates have been used. So 1 plus the effective interest less the coupon will not equal to this closing balance. So the difference over here will be on account of different foreign exchange rates used, and the balancing figure in rupees will give you the foreign exchange gain or foreign exchange loss as the case may be. Sir, where should this foreign exchange gain or foreign exchange loss go? Well, typically this will go to the profit and loss account. Even if it is an investment in bond which is measured at, let us say, FVOCI, because bond is a monetary item, and on a monetary item the gain or loss will always go into the profit and loss account. We have put a separate video as well. This is, I think, an RTP question of November 20 where this concept is used. So you can refer that separately as well. So this is a foreign currency gain or loss which is like the balancing figure. Okay. So if we go to see what do we have to do, you can refer the steps over here. You will first prepare the amortized cost workings in the usual manner in the foreign currency. Then again amortized cost workings by converting them into the functional currency using the respective rates, that is the opening rate, average rate, payment date and the closing rate, and the balancing figure over here will give you the foreign exchange gain or foreign exchange loss. We have summarized and given the rates to be used over here. You can refer that at peace. You can pause it and refer it if you want to. Okay. So this takes care of this special case of amortized cost along with foreign currency. Now you go to the second part of the standard. The first part of the standard involved exchange rate conversion for an entity when it enters into a foreign currency transaction with a foreign party, with a third party. We said at the beginning that let us assume this was an entity which has no subsidiary, no joint venture, no associate, or it has a subsidiary, joint venture, associate outside India, but these are transactions which are entered into with a party which is other than the subsidiary, associate or joint venture. These are not transactions of the subsidiary, associate or joint venture. This is a transaction of the entity with a third party which is situated outside India. Conversion principles. However, you might have a foreign operation. How is a foreign operation defined? A foreign operation is defined to be an operation which is other than an Indian operation. Loosely speaking, it is an operation which has a functional currency which is other than the parent's functional currency. So for example, if there is Tata Motors which is in India whose functional currency is the rupees, and it has, let us say, a foreign operation under the name of Jaguar and Land Rover whose functional currency is, let us say, the pound. Now Jaguar is largely independent of Tata. It has an ability to finance its own operations. It is not really dependent on the parent. It has its own models, technologies. It has its own sales, own ability to raise finance. It is like a mature boy, not a baby who needs the care of a parent. So these are foreign operations. Because they are able to finance their own operations independently, they are considered to be a foreign operation. Okay, so what can happen over here is, now Tata would enter into transactions with various parties. In a similar way, Jaguar would enter into transactions with various parties. Now Jaguar is a British operation which is 100% controlled by Tata. However, for Jaguar standalone, if someone says what is a functional currency, well, Jaguar predominantly, let us hypothetically, sells cars in the UK only. It manufactures cars in the UK only. It is affected by the competitors of the UK only, and as a result, let us hypothetically, the functional currency of Jaguar standalone financial statements is the pound. All goes well, the accountants of Jaguar pass entry in pounds. Everything is recorded in pounds. Things go smooth till the time you have to do consolidation. Now Tata Motors has to consolidate the operations of Jaguar into its own financial statements in order to prepare the consolidated financial statements. Okay, so we have studied Ind AS 103, 110. We know how consolidation happens. Excellent. However, you have largely done consolidation where the currencies were the same. And as a result, you would do a line by line consolidation. 1,000 rupees of PP of the parent, 100 rupees of the PP of the subsidiary, you join it because they are both in rupees. Now the problem is Jaguar's PP or Jaguar's debtors or Jaguar's creditors or loans are not in rupees, they are in pounds. So can you join rupees and pounds? No, you have to convert. So what will you convert? Will you convert parent into subsidiary or subsidiary into parent? Typically the law says you will have to convert the subsidiaries or the joint ventures or associate, as the case may be, financials into the parent's functional currency. So if the parent's functional currency is a rupee, you will have to translate Jaguar's financial statements into rupees. Okay. So, sir, how is it different from foreign currency transactions? This is just a book translation which happens in your Excel sheet. Sir, we are not understanding. In the first part, you had actually exported goods to a US client. That US client in May would actually write a check and give you that. In May, you will convert that into rupees, and those rupees will actually come in your bank account. On the other hand, Jaguar is a fairly independent operation. Jaguar is going to continue its business, its operations in the usual manner. It is not going to sell its property, plant and equipment, get pounds, give it back to the parent. Apan abhi bacche nahi. When you were a kid, you would go running to your parents for pocket money. If someone gives you money, you would go and give it to your parents. अभी अपने बच्चे नहीं हैं, अपने खुद का पैसा खुद कमाते हैं, आर्टिकलशिप में जितना भी कमाते, खुद का पैसा खुद कमाते, and we spend that money. So we are largely independent of the parent. Sir, why are you discussing this? Well, because the law over here thinks that JLR is going to earn in pounds, have its assets in pounds, and keep everything in pounds only. It is not going to repatriate anything back into rupees. It might give you some dividend here or there, but largely it is not going to repatriate anything back in rupees. And hence, when I translate Jaguar's PP, Jaguar's debtors, Jaguar's loans, this is just a book transfer, because in reality, Jaguar will collect the debtors and not repatriate the money back to India, but use that money from the debtors, let us say, for its further business expansion and for paying its business expenses. And as a result, if money is not going to change hands, not going to convert into rupees, the gain or loss that is going to be earned as a part of this translation is a notional gain or loss. Till the time you actually sell Jaguar, when the entire operation goes away and that money will be converted, but when you sell, we don't know. And as a result, the law over here says that till the time you are holding that foreign operation, and if any gain or loss arises on the mere translation of the financial statements, that has to be parked into an account called as a Foreign Currency Translation Reserve, FCTR. It should not be taken to the profit and loss account, the logic we just discussed, because it is just a book entry. You have to convert everything into rupees in order to prepare CFS. That does not mean JLR is going to give you everything back in rupees. Like in case of debtor, creditor, in our foreign currency transaction, if you export, you are going to get actual dollars, which you will convert into actual rupees, which is not the case in JLR. JLR is going to collect the pounds from its debtors, use those pounds for paying its salaries to its employees. Money is not going to come to India in general, and hence the gain or loss, if any, will be parked into a separate account called as a Foreign Currency Translation Reserve. Over here, there is some theory where additional factors have been given to identify whether an operation is a foreign operation or not. Typically, the litmus test over here is, does this operation, which is outside India, does it have an ability to finance its own self? If yes, it is a foreign operation with a different functional currency. If no, it is not. You look at other factors like proportion of transaction, dependence on parents as well. You can go through that, but that is a subjective assessment. Acha, the important principles over here are the translation principles. Sir, we are getting confused. We just studied principles. Those were principles for actual foreign currency transactions where actual money is going to flow. Here, there is a trial balance and a balance sheet of a foreign subsidiary or a foreign branch or a foreign joint venture or associate, which you have to merely translate for the purpose of consolidation. So at what rates are they going to be converted? The law says that income statement items, sales, purchases, etc., income statement items have to be ideally converted at the rate prevailing as on the date of the transaction. However, this exercise can be very tedious, especially for a foreign operation where hundreds and thousands and lakhs of transactions would have happened in a year. You recorded everything in tally in your pounds, and now you have to convert each and every transaction. That will be a very cumbersome process. Next financial year aa jayega. And hence the institute gives you a little leeway. It says, okay, we understand that there'll be tons of transactions. You can use the average rate to convert these incomes or expenses will be converted at the average rate for simplicity, and this is typically what is going to come in your exam. Secondly, assets and liabilities. There's an important point over here. In this case, both monetary and non-monetary items are going to be at the closing rate. Sir, but non-monetary should be historic rate. Yes, typically it should be historic rate in case of a foreign currency transaction. However, here you are merely translating it, and whatever gain or loss comes on translation is in any case not going to the P&L. It is going to go into the FCTR, and hence the standard allows you, AS 11 as well as Ind AS 21, to show all non-monetary items, all monetary items, assets and liabilities at the closing rate. Remember that, an important point. Every item has to be translated at the closing rate. A part of the logic over here is that this gain or loss which is in FCTR is the gain or loss for the entire operation. When you lose control over JLR, you are going to lose control over all assets, all liabilities, monetary as well as non-monetary of JLR, and hence the translation reserve that you are building is for the entire operation and not just for the monetary. Though technically monetary only would be more reliable, more accurate, though in this case, since P&L is not getting impacted, the standard takes a slightly more aggressive view, and it says, okay, take monetary and non-monetary both. In any case, the gain or loss now is not going to the P&L, it is going to go to the FCTR. And whenever you are selling that foreign operation, the gain or loss which is there in the FCTR will be converted and recycled back into the P&L when you sell that foreign operation. We will study that for the entire operation, monetary as well as non-monetary. So just remember that closing rate for both monetary and non-monetary. Equity, share capital and reserves are, remember, not assets or liabilities. They are there in the balance sheet, but they are not assets or liabilities. They are a part of shareholders funds. Equity section jisko apan bolte hain. So equity will be converted at the rate as on the date of acquisition. So when parent acquires control over the subsidiary, so for example JLR might be in existence for the last 70 years, but Tata acquired control over JLR, let us say in the year 2008. So for the Tata Group, the consolidated statements come into existence from 2008 with JLR, and hence the share capital of JLR, which cannot be remeasured, will be converted at the rate as on the date of acquisition, that is the 2008 rate. Reserves, remember, pre-acquisition reserves have to be eliminated, post-acquisition reserves have to be consolidated. So pre-acquisition reserves technically are actually acquired. You as Tata Group have not earned them, they're acquired, and as a result the pre-acquisition reserves, if you need to convert them, will be converted at the rate as on the date of the acquisition, because you have not really earned them over time but acquired it in 2008. However, the post-acquisition reserves have been earned, so each year's reserves will be converted at the average rate of that each respective year. So over here this will be converted at the average rate in the post-acquisition period. These will be converted at the average rate as on the post-acquisition period. Okay. The foreign currency translation reserve, FCTR, the foreign currency translation reserve is typically calculated as a balancing figure. Sir, how? Well, if each asset, each liability is converted at the closing rate, equity, share capital at the rate on the date of transaction, pre-acquisition reserves at the rate on date of transaction, post-acquisition reserves, incomes, expenses at the average rate, you are using a buffet of rates. So your balance sheet, which was tallying in dollars, is not going to tally in rupees, and it is not tallying because you're using a multiplicity of rates, and hence the balancing figure in the balance sheet is on account of the different rates used, and hence the balancing figure can be called as FCTR. There are other alternative ways to calculate FCTR as well. This is just one of the ways. This FCTR is the difference in the balance sheet which arises because of different foreign exchange rates and would be classified as FCTR. This is a reclassifiable FCTR, which means this will remain in FCTR, and on the happening of a particular event, that is loss of control over a subsidiary, the balance in the FCTR will be transferred to the statement of the profit and loss account. It is reclassifiable. And lastly, goodwill on consolidation. One always thinks that goodwill cannot be remeasured. Perfect. But the goodwill in foreign currency will not change. Goodwill in foreign currency will remain the same. Like the subsidiaries, assets, land, building, machinery, maybe at the cost model, they will also not change. However, you convert all items, monetary as well as non-monetary, at the closing rate. And hence the standard says, even if there's a goodwill on consolidation, that goodwill on consolidation will be converted at the closing rate, like every other asset and every other liability was translated at the closing rate. Goodwill is also an asset, will be converted at the closing rate. Sir, goodwill cannot change. Goodwill in dollars will not change. Like land, if JLR had acquired some land, that land in that foreign currency will not change. But if you convert that into rupees, for example, that will be at the rate prevailing as on the closing date, because all non-monetary items in case of translation will be at the closing rate. Okay, so this is an important point to remember. Apart from that, there are two additional adjustments which are linked to consolidation. If you have done consolidation, probably this will give you some insight. Like, there can be unrealized profit in stock. So there can be an upstream or a downstream transaction, and there can be an unrealized profit in stock. How do you eliminate it as a part of consolidation? Well, the entire profit you eliminate. And the second effect goes, let us say, against the inventory. However, what if this is in the foreign currency? Well, remember, profit is earned as on date. Profit is not as on the balance sheet date. Profit is earned on the date when the sale happens. And hence, ideally, if you have to eliminate profit, you will go and find the profit in dollars. This profit, let us say, the parent had sold goods to the subsidiary, the subsidiary had sold goods to the parent on, let us say, 2nd of February. So on 2nd of February, what was the rate prevailing? That is the rate at which profit would have been earned. And if up to the balance sheet date, the purchasing company is not able to sell these goods to an outsider, then that profit which was earned and recorded has to be eliminated. So that profit was earned on 2nd of February, and hence ideally it should be eliminated at the rate as on 2nd of February. If such rates are not given, then at the average rate. Profits have to be eliminated using the rate as on the date of profit is an income/expense, right? So if you are eliminating the profit, it has to be at the rate as on the date of transaction, or if you are using average rates, then at the average rate. Okay, intercompany balances between the parent and subsidiary. This is a fairly complex assessment. In your full class, we would have done very detailed examples. Right now, time does not permit as detailing over here and too much of complexity. I'll just give you an overview. What happens is, when there is a parent and subsidiary and there is an intercompany debtor or creditor, you typically eliminate the intercompany debtor and creditor. So there is, let us say, a transaction where there is a parent which has sold goods to the subsidiary. Subsidiary, let us say, has sold those goods to outsider as well, but between parent and subsidiary there is a 5-month credit period, which means subsidiary has to pay money to the parent. As on 31st March, there is a receivable in the books of the parent, there is a payable in the books of the subsidiary. Now these need to be eliminated. Let us say the transaction was in the parent's functional currency. Parent rupees mein hai, transaction was in rupees. Subsidiary would have recorded it in dollars if dollar is the currency. And then as on the balance sheet date, the creditors in the books of the subsidiary are in dollars, in the books of the parent, the debtors are in rupees. So you will have to translate that at the closing rate to convert it into rupees, and at the end you will find that the gain or loss will eliminate, the debtor and creditor will eliminate. I'm not doing numericals over here, but agar aap numerical karo to bahut अच्छे से समझ में आता है. Just pardon me for that. It will take another half an hour to go into the detailing over here. So long story short, whenever there is an intercompany receivable or payable, in one books it will be in rupees, in another books it will be in dollars, you will have to convert everything into the parent's currency. However, when you are converting into the parent's currency, the debtor and creditor will eliminate. However, there may be a foreign exchange gain or loss that will continue to appear in the consolidated accounts. That foreign exchange gain or loss is not going anywhere, because this is going to be an actual foreign currency transaction between the parent and the subsidiary. It will continue to remain. Okay. Where will it remain? Ultimately, it will go to the profit and loss, because these are monetary items and these monetary items are restated. So in the standalone books, it will be in the profit and loss. In the consolidated books, also it will continue to be in the profit and loss. Perfect. However, there is one exception to this rule. In case this foreign exchange gain or loss arises as a part of net investment in a foreign operation, बहुत बड़े अंग्रेजी words है. What do you mean by this? For example, the parent gives a loan to the subsidiary. Loan is a monetary item. The gain or loss on the loan has to go to the P&L. However, this is a loan where the parent has given no settlement requirements. It says, हाँ ये loan रखो, we will see when the money is to be paid, you don't really worry about payment. Now, such a transaction, though in legal terms may be monetary because it is a loan, in substance it has the color of equity, because ideally subsidiaries does not have any obligation to pay this money back because there are no settlement terms. And if it was equity, then you don't remeasure it at the closing rate. If it was equity, it will continue at the rate as on the date of acquisition or the rate as on the date of transaction. Monetary and non-monetary items you take at the closing rate. Okay. Now, because this is a loan in the standalone books, you would have treated it as a monetary item and the gain or loss would have been recognized in the profit and loss. However, if this loan is a loan where settlement is not planned, then the gain or loss ideally is actually on books. It is not a real gain or loss. Sir, why? अरे loan होगा तो आज नहीं तो कल loan has to be repaid. Debtor, creditor, आज नहीं तो कल money has to be paid. However, if it is if it is equity investment, money does not need to be paid till the time the disposal of the foreign operation. In a similar way, if this is a loan where settlement is not planned, then ultimately, if I have given you $100, you are not going to give me that $100 back. Like in a typical loan you do, like a typical debtor creditor transaction you do, but in case of a loan where there is no settlement requirements, you are not going to give that back to me, in which case that gain or loss that I must have calculated is actually not going to be realized till the time I sell my operation. Like equity, if I give $100 of equity to you, it is permanent in nature. In a similar way, this loan is permanent in nature. Very deep, detailed concept. If you have done this in class, we would have discussed this at length. So you can refer that. Otherwise, for simplicity, just remember, if there are intercompany transactions, intercompany debtors, creditors, loans, given loans taken, as on the balance sheet date, the intercompany receivables and payables will be eliminated. However, if there is any gain or loss, that gain or loss will continue to appear in the separate financial statements of the entity where the gain or loss is recorded, as well as the consolidated financial statements. However, if there is a gain or loss on the intercompany monetary items where settlements are planned, like a debtor or a term loan of 5 years, then in the SFS as well as in the CFS, the gain or loss will continue to be in the P&L only. However, if the settlement is not planned, like a loan without repayment terms, which the standard says is a part of a net investment in a foreign operation, in such a case, in the SFS, because it is a monetary item, and I mean, I'm looking at my company only, I'm not looking at the group's perspective, then the gain or loss will be in the P&L. However, at the time of CFS, you will have to reclassify. So your entry will be, let's say, P&L account debit to FCTR. You will reclassify it to the foreign currency translation reserve. The logic over here is, because the settlement is not going to happen and it is not agreed, that gain or loss is not going to actually realize. A gain or loss kabhi hoga agar pound se paisa actually rupees mein aayega, which is going to happen if Tata has sold goods to Jaguar, so Jaguar will pay money to you, or Tata has given a 5-year loan, in which case 5 years later Jaguar is going to give money to you. But if Tata makes a permanent investment, or Tata makes a loan without settlement terms, then Jaguar is not going to give that money back. It is understood between the parent and subsidiary, so theek hai. It's not going to give the money back, or if it does, the dates are not agreed, and hence the standard says that this gain or loss is actually on paper, and hence let us put it into a translation reserve rather than taking it into the P&L. Just remember this point. If nothing is given, we will always assume that the settlement is planned, and hence everything remains in the P&L. The last parts of the standard will involve disposal of investment in a subsidiary. This standard has a very strong linkage with the consolidation chapter as well. So if you dispose of a subsidiary, what will happen? Well, all assets, all liabilities will have to be eliminated. If you dispose of a subsidiary and you lose control, then all assets, all liabilities of the subsidiary that was in your consolidated books will be eliminated. It's loss of control entry. All assets, all liabilities, NCI, everything is eliminated. Okay, but what about the FCTR which is lying in your books? इतने साल से अपने JLR का balance sheet में FCTR you kept on creating. What happens to that? Now, once you have lost control, this is treated as disposal of net investment in a foreign operation. The moment there is a disposal of the net investment in the foreign operation, whatever is the gain or loss which is inside the FCTR will now be reclassified, transferred to the PNL. So you will debit FCTR, credit the PNL, not going to retained earnings directly. It is a part of reclassifiable OCI. This is when you lose control over the subsidiary. However, it is possible that you have a 100% stake in the subsidiary and now you are just selling off 20%, in which case you're not losing control. You're just creating NCI worth 20%. Now this NCI has a share in all assets, all liabilities, reserves, share capital, everywhere the NCI has a share, including the FCTR. And hence, if there is a stake sale whereby you're not losing the control, then you don't transfer the entire FCTR to the PNL. In fact, you say that, okay, we had an FCTR worth, let's say 100 rupees. Now 20% of that is attributable to the NCI, 80% of that continues with the parent. Okay, so this is not just for FCI, this is for every reserve, every asset, every liability. So stake sale, the impact on FCTR. If there is a loss of control, the entire FCTR, which is a parent share appearing as a part of your consolidated reserves, will be transferred to the PNL. And if there is no loss of control, then the part of FCTR will be allocated to NCI. So in our example, 20%. This largely takes care of Ind AS 21. A couple of additional points. Can an entity change its functional currency? Well, yes, it can if it changes the primary economic environment in which it operates. So for example, hypothetically, we are not doing that, but hypothetically we say, okay, we now only want to teach US students, we only want to teach US CPA or CFA or jo bhi hai to US students, recruiting US faculties by online coaching centers, etc. Now we are changing our primary economic environment. Our expenses are going to be in dollars. Our incomes are going to be in dollars. The competitors are largely in the US, for example, in which case we are changing our primary economic environment, let us say in the year 2020. In which case, till the year 2020, our primary economic environment was the Indian environment and hence rupee was the currency. After 2020, the primary economic environment is the dollar and hence now the future accounts will be in dollars. That does not mean this is a change in accounting policy which requires a retrospective restatement. No, it is a change in an actual fact, in an actual scenario, and hence the effect will be from the year when you actually change the primary economic environment. And lastly, this is not a change in accounting policy. And lastly, in case the presentation currency is different from the functional currency, the original Coca-Cola India example, you had a Coca-Cola India whose functional currency was in rupees, you have recognized everything in rupees, but now suddenly you want to prepare the balance sheet and the profit and loss in the dollars. How do you do that? Well, you do that by applying these exactly same principles. Whatever are the incomes and expenses of Coca-Cola India will be converted, let us say, at the average rate into dollars. The assets and liabilities as on the balance sheet date converted into dollars using the closing rate. The share capital at the rate when Coca-Cola US acquired control, reserves at the average rate, and so on. The difference, if any, will still be going into FCTR because this is also just a book-based conversion. This is a company which is very much based in India. Okay, so this largely takes care of Ind AS 21. I hope you have got some perspective, you have got some clarity. Do practice questions on this. It is a fairly important standard, has been getting a good amount of weightage in RTPs as well as main exams. So wish you all the very best and hope you like the video. I'll even try to share the notes for the PDF of these notes to the extent possible. I'll just share this on the Telegram channel. If you've liked the video and if you want us to kind of update other videos, please do drop in your suggestions in the comment box. Please do like the video and share it with your friends if you think it is helpful, and please do subscribe. Thank you very much and take care. Good luck. Bye bye.